Hi, and thank you for tuning in. It is a privilege for me to be here. My name is Darrell Young. I currently serve as the chair of the Financial Literacy Committee of the Peninsula Silicon Valley chapter of CalCPA. The California Society of CPAs is a not-for-profit association of over 40,000 members. Our membership base includes students, emerging CPAs, licensed professionals in public practice and industry, academic and research persons, as well as retired practitioners. CalCPA has 14 chapters throughout the state. To learn more about CalCPA, please visit our website at calcpa.org. So we're here today to offer basic tax and financial planning tips. The information presented is not intended to represent advice for your personal circumstances. Our focus will be on federal taxes. California state taxes are not intended to be part of this discussion. Now, I think it's fair to say that most Americans do not enjoy paying income taxes. But why is that? As you can see, the United States government collects approximately $3.3 trillion a year in income taxes. Now, where does that tax money go? It goes to health services, it goes to national defense, military, and a host of other causes. Now, reflecting back on why it is that many Americans don't necessarily like to pay taxes, I think it's largely because the benefit is intangible. So, for example, if I were to walk into a local restaurant, look at the menu, choose an entree, pay my money, get my food in return, I say, hey, it's a fair trade, gave you money, I got back a meal, it's very nice, I'm satisfied. I think that oftentimes the money that we pay to income taxes, we feel that there's not a lot of control over it, the benefit doesn't seem as tangible, and therefore people tend not to like paying taxes. At least that's my belief. Now, let's focus on our next slide, which would discuss who's really shouldering a lot of that burden. Now, if you see in the upper row, the top 5% of income earners in the United States, let's say those families earning $200,000+ a year, well, they actually shoulder nearly 2/3 of the tax income that the government collects. If you take then affluent families that make up the next, say, 15%, so the top 20% of taxpayers, you'd see that they shoulder about 85% of the taxes collected. So again, when you think about whether or not the tax system is fair, just understand that the top 20% of taxpayers are the top 20% income earners. What are the main considerations for doing it yourself versus using a program like TurboTax versus using a professional CPA? I would say that more people are using professionals these days in regards to their taxes for the simple reason that the system is very complex, too complex for a layperson to understand. But where can you go to get help? Programs such as VITA, which stands for the Voluntary Income Tax Assistance Program, or TCE, Tax Counseling for the Elderly, may help you prepare your personal income taxes for no charge. Get information at the IRS website at www.irs.gov, or VITA and TCE have websites as well. Now, of course, you can use tax software to help you prepare your personal income taxes. Many of us have heard of programs such as TurboTax. They tend to be reasonably priced. Some software may be easier to use than others. Again, Tax Act is another choice aside from TurboTax. And the IRS even offers software called Free File. It's available on their website at no charge. Now, of course, the difference between a tax professional, such as a CPA, and software is, of course, the level of hands-on service that you're receiving. With the software, needless to say, you're going to spend a lot of your own time preparing the tax information and entering it. And that is time that would otherwise be spent with your family or doing something that has value to you. It's also important, I think, to keep in mind that tax preparation fees may be deducted, and perhaps that's a consideration for your decision. Are there any significant federal tax law changes taking effect for 2015? Well, let's first identify that the due date is actually April 18th, not April 15th, as most people might expect. The reason for that is that Emancipation Day, celebrated in Washington, D.C., is allowing for that extension over the weekend. April 18th, then, is also the deadline for filing extensions, as well as making your first quarter estimated tax payments for 2016. It also then becomes the deadline for funding your 2015 IRA contributions. The standard deduction, which is different from adjustments, exemptions, and credits, is a dollar amount that reduces the amount of income upon which you are taxed. The standard deduction is $12,600 for married people filing jointly, $6,300 for singles or married people filing separately. Other changes for 2015, the standard mileage rate for business use, 57.5 cents per mile, up from 56 cents per mile last year. Mileage for medical and moving expenses, 23 cents a mile, which is actually down from 23.5 last year, 2014. Under the Affordable Care Act, typically referred to as Obamacare, the penalty for not having your health coverage in place is the higher of 2% of your household income above your filing threshold, or $695 per person in your household, up to a maximum of $2,085 for a family. For 2015, the IRS limited non-taxable rollovers are extended to 12 months, and that's regardless of how many IRA accounts you have. This change does not affect trustee-to-trustee transfers between custodians. Conversions from a traditional IRA to a Roth IRA are not limited by this provision. And one other note of change for 2015, the Earned Income Tax Credit has been made permanent. Congress has made permanent a provision known as Internal Revenue Code Section 179. This provision allows small businesses to immediately expense assets purchased up to $500,000 that would have otherwise been capitalized and then depreciated over their useful lives. Generally 5 to 15 years in terms of the depreciation life. The $500,000 phases out once your purchases exceed $5 million for the year, and furthermore, these amounts are indexed for inflation. For the average Bay Area family, what are some of the steps that they can take to save on taxes? For example, how about commonly missed adjustments, deductions, exemptions, etc.? Well, from what I gather, one of the most common mistakes is that people often provide the wrong Social Security information on their dependents. Now, if the IRS cannot properly match the Social Security number of a dependent in your household, it may deny you a particular filing status, personal exemption or deduction, educational tax credit, child tax credit, or dependent care tax credit, something that you would otherwise be entitled to. Most people mail in their tax returns without certified mail. If the IRS does not receive returns by the deadline, the burden of proof falls on you, the taxpayer. And if you're unable to prove that you filed on time, it's very difficult, if not impossible, without the certified mail receipt from the Postal Service. The IRS can and will assess late filing or late payment penalties against you. And you may lose out on certain elections, such as an election to request automatic extension of time to file your return. Another quite common mistake is that taxpayers do not report as a deduction the state tax payments made for prior years during the current year. Now, most, if not all, individuals are on the cash basis method of reporting income and deductions. And as a cash basis taxpayer, you are entitled to claim as a deduction the state taxes you paid during the year, regardless of the year for which the taxes were paid. Another one, most people do not report the deduction either because they do not know or they overlook it. What are some of the main considerations for choosing between traditional IRAs versus Roth IRAs? With the basics, the Roth IRA contribution limit for 2015 and 2016 is $5,500, or for those aged 50 years and older, $6,500. Roth IRA contributors who are married filing jointly reach the phase-out range at a modified adjusted gross income of $183,000 per year. And at $193,000 per year of modified adjusted gross income, those Roth IRA contributions become ineligible. Single filers, as opposed to married filers, reach the phase-out range at $116,000 of MAGI, and then they become ineligible at $131,000. I suppose the main benefit of a Roth IRA is the income earned over time. It's not taxable to you when distributed upon retirement, assuming that you've met all the various requirements. So, if you happen to be 40 years old and you stash away money in a Roth IRA account, earning a competitive rate of return, you would actually amass quite a large amount of money and have that be tax-free to you upon retirement. Another nice benefit of the Roth IRA is that it is not subject to required minimum distributions as it would be with a traditional IRA. So, in essence, the Roth IRA allows you to keep the money in the account longer, enhancing the compounding even past the age of 70 and a half. As a side note, I think that most of us would agree that tax rates are not likely to be lower in the future than they are now, and for that reason, it seems prudent to pay your taxes now and have your account grow, Roth IRA, assuming you're eligible, and have it be tax-free in the future. Well, frankly, that's probably beyond the scope of our discussion here. There are specialists who deal with estate and gift taxes. This is a really complicated area of the tax law and requires professional expertise most of the time. I would say to you the best possible suggestion would be to get ahead of the issues. Start the conversation now with your CPA or attorney, somebody who's familiar with your family background and dynamics. On that note, I'd like to thank you for your time and attention during this session. Really hope that the information was helpful to you. The questions and answers were largely supported by my good friend, Mr. Mel Nguyen. He's a senior tax manager at Seiler here in the Bay Area. And I would encourage you to reach out to the California Society of CPAs if ever you think we can be of assistance. Thank you.